Well, good morning and welcome to the very first FS Club event of the new year 2025. It is a bit of a tradition around here to start the new year with one of our absolute favorite guests, Dr. David Doyle, who's on the board of the Kangaroo Group. And David has always spent the very first session of the year outlining for us what's happening in Brussels, what's happening in the EU in financial services legislation, and the various associated initiatives. Now, you'll know me. I'm Michael Mainelli. I am one of the directors of Zien. I've been on a sabbatical for a year and a bit as Lord Mayor of London, but I'm back with it, not with a vengeance, but with a renewed interest in the importance of these many, many subjects. For those of you like to see what is FS Club all about, here are our various sponsors. But I like to call FS Club really more future scenarios. It is really the premier place for people who want to discuss technology, economics, and finance, and that will come across today in particular. Although I think we'll have a bit more of a financial emphasis for obvious reasons. Regulars to these programs will be aware that the idea is to give our guests approximately 15 to 20 minutes to outline the situation and talk about things, and then we engage in 20 minutes of Q&A. So please sharpen your pencils. But 11:25 sharp, we will turn to you, the audience. To work on that, it's really quite simple. You use the GoToWebinar question facility. All of your questions will be coming up here. And for those questions that we don't have time to answer, nevertheless, David will receive all of the questions with your email attached so he can get hold of you directly. So if there's something you would like to point out to David, or you just like to chat to him privately, just put it in the chat room and he will get that. So finally, if I might point out, whilst we're here and discussing these issues, we would hope that you find ways to encourage others to explore and expand on this discussion. And in so doing, please, again, feel free if you think there's something we, Lucas behind the scenes and me up here, should be putting out to the audience, just, again, type it into the chat room and we'll rebroadcast it. Now, I think at that point, with no further ado, David, it is always a delight to have you begin our year. Let's get going.
Okay, thank you, Michael, and greetings to you all and a happy new year. Well, as 2025 begins, one could be forgiven for not thinking that the European Union is facing some major compelling challenges. Despite the fact that last week the European Central Bank President, Madame Lagarde, was very victorious in her statement saying, I think we've beaten inflation. We're now down to 2.4%. We're looking at a 0.25% drop in interest rates between now and the end of this month, and perhaps 3 or 4 others, which in the words of one economist I spoke to, said that this will bring the level of interest rates down to a position where it's neither a situation of stimulating or restricting economic activity. But probably the big issue facing us this year is that the EU faces some very fragmented and polarized political elections coming up. Germany, Poland, Austria, which will face elections, but the recent far-right Freedom Party has now seemed to grabbed a core position within the government, which consolidates the rising influence of far-right populist parties across Europe. And at the European Parliament itself, we've seen a distinct shift in the political landscape from the centre left to the centre right, where the leading EPP party is now forming a new supermajority with the right-wing and far-right groups in the European Parliament. And this will present certainly certain challenges in relation to advancing the so-called green initiatives. So I can see challenges in terms of dealing with the future climate policy issues, which is best exemplified in the statement by one European centre-right member saying they are costly green and degrowth thinking behind this. In short, Brussels faces a pivotal year in terms of economic and financial challenges. Now, the other big issue on the agenda, of course, arose from the former Italian Prime Minister Mario Draghi's competitiveness report, which underlined the degree of challenges the European Union needs to address, particularly in relation to innovative firms wanting to scale up, which Mr. Draghi believes are hindered, quote, hindered at every step with inconsistent and restrictive regulations. And indeed, the president of the European Commission has announced a couple of months ago that one of the core priorities going forward will be reducing the onerous administrative burdens, notably in relation to reporting requirements, which is important for the financial services sector, by 25%. And to back all this up, if you look at the 100 top tech-related laws that have been introduced across the 27 EU member states since 2021, there are now some 100 separate pieces of legislation enforced by 270 regulators, including the Digital Services and the Digital Markets Acts. The other big, I think, question, given the outcome of the US elections, and we cannot avoid this, but the expectations that I'm hearing from certain people in Brussels about promoting the strategic business interests of the European Union to avoid becoming a collateral damage in the global trade war that could follow from some of the statements made by the incoming US president. And what I see happening is reinforcing and an emphasis on strategic autonomy. In other words, more emphasis on local supply chains, local manufacturing, local indigenous financial services industry providing services across the entire European Union. Next slide, please. So in spite of the continuing significant support, I would say, in terms of green investments in Europe, there is also a very noticeable increase in hostility from the financial services industry and indeed from the current component of right-wing MEPs to water down some of the European Union's ESG disclosure ambitions. And some of this has been encapsulated already by the statement made by the Commission last week that they intend to consolidate existing and future EU ESG reporting obligations into one massive omnibus regulation, which would greatly, I think, facilitate the interpretation. The other issues that have come up is the need to tweak the so-called sustainable finance disclosure regulation, which requires financial institutions to actually report and quantify and disclose how their financial strategies, their products, their services actually affect adversely or otherwise the environment. And of course, only this week we had the Chancellor Scholz from Germany calling publicly for a review of the CSRD, that's the Corporate Sustainable Reporting Directive, which has this double materiality reporting factor. Not only do you have to report on how you as a company affect the environment, but equally how the environment affects your policies going forward. So a lot of things happening in this space. I think we will see quite an emphasis going forward into 2025, not necessarily in removing legislation, but certainly, or even deregulating, but certainly facilitating and simplifying the reporting requirements going forward. I mean, the Commission has been very clear that it needs to review, for instance, the infamous Article 7, 8, and 9 of the taxonomy regulation to make it more user-friendly and to be able to help industry, both financial services and otherwise, to actually distinguish between what is harmful to the economy and what isn't harmful. The other major piece of legislation, of course, is the EU Artificial Act, which has set a global standard, and clearly the US and the United Kingdom and other parts of the world are not following the same very comprehensive and very detailed piece of legislation. But the Commission has announced that it will need to perhaps make some pretty significant refinements to this Act in terms of its impact on the financial services industry. And they've launched back in November a public consultation, which is well worth following, as to how and for which purposes the AI applications are used in the financial sector. Now, we should bear in mind that the AI Act does indeed classify certain AI activities in the financial services sector as being high risk, which we already know of, such as credit scoring systems, automated insurance claims processing, risk assessment tools, particularly in the health insurance sector, the provision of investment advice to retail investors via chatbots. In other words, in short, all of the AI models that will be permitted need to be vetted and approved by the regulators before they can be put in place. And the other important issue here is also to bear in mind that the ultimate responsibility and indeed liability for the misuse of AI applications in the financial service sector remains with the original AI creator and not the licensee firm that is actually helping to implement it. So you as a bank, an asset manager, an insurance company, if you're developing AI models, you remain responsible for its misuse further down the food chain. The other question, of course, is the US divergence, and I think this is no longer an apparent divergence, it's a real divergence in terms of its approach to reducing burdens on the financial services sector. Already, Mr. Trump has made it clear that he will be reviewing the so-called Basel III endgame with a view to perhaps reducing some of the capital charges. There are also a range of other initiatives being taken to facilitate the funding capacity of banks, both large, small, and medium-sized banks in the US. And also there's a massive lobbying campaign as we speak being conducted by the private credit, private equity industry to encourage more funding from pension funds and institutional investors, insurance companies in private equity and the non-banking sector in general. The other big struggle, of course, the EU has to face is dealing with its distinctly underdeveloped capital markets. The figures speak for themselves. The household financial investments in Europe is about 17% compared to 43% in the US. The confidence level in Europe in terms of investment advice is around about 45%. In other words, there's a majority of citizens in Europe who don't seem to have great confidence in the advice they're getting at the moment. And to make things worse or accentuate the problems, citizens in Europe, retail investors in Europe, find themselves paying 40% more in costs charged compared to institutional investors. All of these issues are now an integral part of the retail investment strategy, which is being discussed as we speak. And some of this will lead to some pretty radical, I think, measures such as banning inducements entirely, notably between the distributors and the retail investors, but also now mandatory annual statements to set out the costs and the performance of investments, and also mandatory risk warnings that are provided on a regular basis to retail investors going forward. The other question that is now being discussed, and I have to say that this is a really important emerging consensus that I'm seeing after 7 years of struggling to try and find the appropriate supervisory structure and architecture for the non-banking sector, the non-insurance and non-banking sector. What I'm referring to is the security sector, the investment fund sector. And here we're now talking for the first time seriously about setting up a centralized, independent, standalone SEC type of EU regulator that would potentially be ESMA which would remove some of the problems that they have in terms of conflict of interest. It would become independent, standalone, and it would become a bit like the ECB's SSM that would supervise directly all of the major non-banking entities in the securities markets. And the other question, of course, that's being reviewed is a revamping of the product design and governance rules, banning commissions, value for money. All of these issues are now part of the retail investment strategy. Next slide, please. Now, we've spoken about the pretty, I think, inevitable, inexorable move towards divergence between the US, the EU, and indeed other parts of the world in terms of financial services regulation. The Basel III endgame, artificial intelligence, in my view, will follow a more permissive policy. There will be a reduction in the compliance burdens on banks. There will be perhaps a prospect of banks actually making equity investments in fintechs, something that was up to recently not seen as being the right approach, but quite visibly a different approach compared to the rest of Europe. Not that the situation is considerably more, shall I say, positive in relation to the United Kingdom and the EU, where I see rule making further diverging vis-a-vis both of these major regions. Already we're seeing divergences in terms of listing of prospectuses, MiFID II, the securitization regulation, PRIPS, the money market funds, and of course the consumer duty and ESG. However, under the EU-UK Trade and Cooperation Agreement, the first, or indeed the second EU-UK Financial Regulatory Forum was held between the EU and the United Kingdom back in May, which I thought was very promising and very constructive. A lot of issues were raised, such as the digital financial sector, the AI sector, asset management, AML and banking specifically, sustainable finance and shadow banking. And the key word that came through this very constructive exchange of views between the UK and the EU was the interoperability in terms of standards. So there is at least an attempt made to avoid divergence and regulatory arbitrage. The other question I think we can expect more of is in the EU legislative agenda is the reliance on extraterritoriality clauses in much of the legislation. The most prominent case must be the AI Act, which means that even those software providers or AI platform providers or creators or distributors based outside the European Union are banned from operating in the European Union unless they have a local entity in one of the 27 new member states. And this equally applies to DORA, the Digital Operational Resilience Act, which provides for a total ban on any third-party ICT provider that provides critical ICT services to EU or indeed foreign banks or insurers or other financial entities based in the EU. In other words, you must have a local entity. So the extraterritoriality factor, I think, is now a prominent, integral part of the new legislative agenda going forward. And just to mention one other, I think, an issue that I was following very closely over the last 3 or 4 years in terms of the so-called EU banking package, the CRD6 package, which has now introduced a brand new third country bank branch chapter, which is expected to further restrict banking activities across the EU region. In other words, if you are providing as a bank, a foreign bank, or as a third country bank, lending consumer credit agreements relating to immovable property, or factoring or financing of commercial transactions, you are required statutorily to set up a branch in that specific EU member state. And the other issue that comes through quite visibly is a removal of remote-based banking provision to the 27 EU member states. If you're providing these services, you need to set up a local branch, and that branch will only be valid, legally speaking, for the provision of banking services in that jurisdiction and not across the EU member states as a whole. Next slide, please. Now, we have a new commissioner who has just started actually on the 2nd of December. Her name is Maria Luis Albuquerque, who is, for me, it's a great relief to see somebody with some financial services background. And we haven't had somebody of this caliber, in my view, since Charlie McCreevy, the Irish former finance minister and chartered accountant. This lady comes with quite an impressive background as former finance minister. She was also responsible for winding down the Portuguese bank, Espírito Santo, you may recall, under very, very difficult conditions. Now, she has some very determined views as to how she sees her role going forward. She's going to be, I think, taking a very hard line on the full implementation of the Basel III banking capital requirements. And she's very supportive of, indeed, of applying these standards to all of the 4,500 banks, not just the large internationally systemically important banks. She's also going to start looking at local bank subsidiaries and how they benefit from support from their parent holding company, whether they are European or they're foreign. Now, the trouble we are facing here is the locking in or the capturing of capital and liquidity in individual jurisdictions, which has been a big impediment for the expansion and mergers and acquisitions of banks across Europe. But she's going to obviously open this debate, and it needs to be opened to ensure that we don't trap capital and liquidity in subsidiaries or indeed in branches when they could be used effectively and deployed elsewhere. The other issue is to look at the supervisory toolkit for so-called private markets. Now, let me be clear about this. The private markets outside of banks and so on have expanded in the Eurozone from something like 15 trillion to 32 trillion euros in 2024. In other words, there's a growing proportion of financial transactions taking place outside of the regulated framework that we would normally associate with banks. And this is now translating into falling quality of some private credit issuers, which have high default rates on their leverage loans. So quite visibly, she's not alone in thinking this. Discussions with the European Central Bank have revealed that there are some concerns about this as well, that there is this correlation of risks between the private equity, private credit, as it were, issuers and the banks that needs to be further disclosed with new liquidity requirements coming in. And ESG disclosures, which we've already spoken about. Michael.
Yeah, we're coming up to Q&A time, so just giving you a monitor there.
Okay, thank you. So next slide, please. And let me try and just touch on some of the other key priorities. The one that strikes me as being a game changer is the ensuring implementation and enforcement of the anti-money laundering strategy via a brand new independent standalone AML authority, which will start operating from 2026. Now, it will do so by selecting 40 obliged entities, banks for the most part, that are operating in at least 7 EU member states, or those banks that have a high ratio of transactions with third countries, or indeed have had a history of high risk profiles in terms of some of the transactions they undertake, whether it be by type of customer, geographical region, delivery channels, products, or transactions. Quite visibly, 40 plus entities are going to be directly supervised by this new AML authority beginning 2026. The other one is the securitization. I am not sure this is going to go very far. It hasn't been a great success in Europe. The Commission has launched back in October a target consultation. to look at ways of accessing to finance for SMEs. It's a comparatively costly mechanism that limits its practicality. It requires large pools of small assets and indeed even larger volumes of funding, which favors obviously the larger banks. But the big issue involved here, though, is the massive shift away from banks to the non-banking sector, which is seen as being less properly regulated. Next slide, please. DORA. There's only 4 messages I want to deliver here. One, we have this statement going back decades: know your customer in terms of AML. The primary, I think, driving factor here is know your ICT provider, know your vendor. With increasing numbers of banks and financial institutions outsourcing their ICT, particularly to cloud, the issue surrounding DORA is for you as a financial institution to take full statutory legal responsibility for overseeing your ICT providers. So there's a whole range of measures that need to be undertaken, and it becomes particularly important in relation to third countries, so that I mentioned already. If you are a third country ICT provider providing critical ICT services to you as a financial institution in Europe, that is to say critical to the ongoing operational day-to-day functioning of the bank or the insurance company, you will be banned from doing so. You will have to set up a local entity somewhere in the 27 EU member states to provide ongoing ICT services. And the other, I think, important factor is the new role given to ESMA, EIOPA, EBA. Once you become a third-party critical ICT provider, in other words, providing critical services or services in support of critical and important functions within a bank, you will find yourself being not alone overseen by you as the bank in terms of ensuring continuity and robustness of the ICT systems held by the third-party provider or vendor, but also you will have these 3 ASAs also getting involved, ensuring sort of collective oversight, not alone of you as a financial institution, but also of the critical ICT third-party providers. So some huge implications, and we're only 8 days away from the full implementation on the 17th of January. Last point, next slide, please, is just to point out the importance in terms of renegotiating with all of your third-party providers in terms of setting service standards, and these will be defined by the regulatory technical standards which are outlined here. For instance, the number of clients that are affected by any incident that exceeds 10% means that you have an important critical incident that must be reported to the regulator, and also will draw the attraction of ESMA, EBA, or otherwise. The other, I think, important factor, and I'll end on this, is the reputational damage. Now, there is a statutory requirement for third-party ICT providers to ensure and guarantee going forward that any downtime due to cyber attack or a simple software update or outage of any sort needs to be less than 2 hours. 2 hours. That has to be incorporated, enshrined in the new, as it were, service standards agreement that you will have to negotiate with all of your third-party providers going forward. And equally, these rules apply to even internal intergroup ICT services as well. On that note, Michael, I will pause there and happy to take any questions. Thank you.
Excellent, David. And in fact, we'll just leave this slide up for a moment as well, if we could, Lucas. David, it is always wonderful to have you kick off the year, because I think it's very salutary, particularly here in London, where we both look enormously global, and then we do have a tendency, for want of language or whatever, to look to America, to forget that right on our doorstep is this gargantuan market, and it's at least as important or more important. I'll start off, if I could, with an interesting question from Paul. Great talk, David. Very illuminating. You paint a regulatory picture of the EU being at one end of the spectrum, high regulatory burden, to US, low regulatory burden. I'm not actually sure I agree with that, by the way, but let's leave it at that. Where the gulf between the two economies appears to be widening going forward. And yet you haven't mentioned our PM's intervention in the regulatory sector recently, where he charged all regulators with reducing the regulatory burden placed on UK firms, presumably on the basis that this will help boost UK
Yeah.
productivity. How much
Yeah.
does that apply to Europe? How much does it apply to America? Does anybody
Yeah.
in Brussels care or notice?
Yeah, well, they do. They do quite visibly, and this goes to the heart of the Mario Draghi competitiveness report, where he relentlessly emphasized the need to reduce the regulatory burden. That doesn't mean deregulate, but what it does mean is reducing the reporting requirements, particularly in the fintech space, in the digital and the green agenda ESG space. There is huge work to be done in Europe in terms of reducing the administrative burdens. In broad terms, I mean, the US, the UK, the EU are broadly speaking going in the same direction in terms of an orthodoxy to reduce burdens on industry, on banks, and financial institutions in general. It's just the scope of this is slightly more complex in Europe, because the European institutions have gone for very comprehensive, all-embracing, game-changing pieces of legislation, notably in DORA, the EU AI Act. One could even argue the banking package, but it means continuing, and indeed this is part of the approach that is being taken by the new College of Commissioners, is looking very closely at existing legislation and asking oneself, is this still relevant? Is it still burdensome? Are there still issues in relation to misinterpretation or divergent interpretation? And this is going to lead not alone to, I think, not so much a deregulation move, but as a simplification move, but also I think it's going to push Europe in the direction of creating a standalone SEC type of securities regulator in Europe. Long overdue. It wasn't terribly popular in the United Kingdom when the UK was a member of the EU. It was opposed by the French because they felt they were going to lose, and indeed other countries as well, because they were going to lose some political powers, as it were. But there seems to be now a rejuvenated and very insignificant consensus in favor of opting for this new SEC structure. So that's the context I think we need to look at, compared to the United States in particular.
Okay. Well, David, if you could keep this brief, it's really from me, but haul me up. But I don't recall you really talking about the Capital Markets Union. And we had a session here in the Guildhall in September where my guest was Pascal Donoghue, who gave a very eloquent defense and re-emphasized the importance of achieving the CMU, which of course, we in Britain were behind the CMU as one of the instigators and
Yeah.
are still pro the CMU, despite Europeans thinking we want to sabotage things, but we clearly don't. We really,
Yeah.
really do support it. Is the foot off the pedal on that one?
No, it's not. But I think after somewhat mixed results over the last 7 or 8 years, I think the commission, this new commission, has decided to perhaps emphasize more, not so much the capital markets union as much as the savings and investment union. And indeed, the DG FISMA, the commission, has now been rebranded as the Directorate for Financial Services and the Savings and Investment Union, which I think is actually quite important. It's an important substantive, I think, change in the orientation. The issue is simply this: how can we release something like 13 trillion euros of savings of European citizens that languish in bank accounts that are providing mediocre yields in the medium to long term, and redeploy it, reallocate it to productive investments. And this is where we're going to have to reopen, as the US is doing at the moment, reopen all this orthodoxy about the private equity, the private credit field, alternative investments, infrastructural investments, where citizens can actively, with the necessary safeguards, actually invest in standardized, safe products that channel money into productive investments. And this will also include investments in the green agenda, digital agenda, and some might even say security and defense as well, given that we need to boost in Europe our defense expenditures in terms of GDP. So no, it hasn't fallen off the agenda, but the emphasis and the reorientation is now different. It's towards investment, a savings investment that can be redeployed under the necessary safeguards to provide the necessary funding going forward to boost the EU economy.
David, we're really we've got a lot of questions here. So we've got my dear friend, one of our stronger community members, Joachim van Hallatz. DORA. You spoke about DORA. Is DORA actually of global relevance, since third parties based anywhere outside the EU have to comply as well? And how quickly do you expect fines to be handed out for not complying with DORA after the 17th?
Yeah, good question. Look, I think there's a recognition amongst the regulatory community in Europe that the 17th of January of this year, like in 8 days' time, is not going to be sufficient to allow the bulk of the financial services industry to renegotiate with all of the third-party providers along the lines that is prescribed under DORA. So there is going to be some degree of flexibility, both at national competent authority level, but also amongst the ACERs and the ECB as well, by the way, who oversee this in terms of those 114 banks. I don't think that the regulators are going to start fining or penalizing financial institutions. If anything, the orientation at the moment, the thinking at the moment is how can we help facilitate the application of DORA at least in the important sectors, such as cloud, which is massively used by banks and insurance companies, and also ensure that there's a standardized template that can be provided to financial institutions, which, by the way, is provided under DORA anyway. There's a lot of very detailed, very useful information, albeit it was released very, very late. The latest one was back in September, which related to regulatory technical standards when it relates to subcontracting on the part of third-party providers. The point I'm making is, no, I don't think it's going to be about penalizing industry. It's about trying to facilitate the application and the transition. And yes, third country financial institutions, if they operate across Europe, whether it's a branch or a subsidiary, will need to apply this fully from, let's say, June of this year. So for me, I'm kind of surprised that we hadn't thought about DORA before. There are some massive issues in relation to cyber attacks and outages that have catastrophic results for financial institutions.
There was a specific point, though. How quickly do you expect fines to be handed out? Are there going to be a couple of quick ones? Pour encourager.
I don't think so. No, I don't think so. No, I think this is a new piece of legislation. I mean, the ECB has made it very clear that it will not be looking at, for instance, imposing capital charges on those banks that don't apply DORA on time or correctly. They'll be working with them in terms of a plan of action, a time frame to be able to bring those banks in line with DORA, and they will be monitoring them more frequently and more robustly than they did in the past. So I don't see the fines being an integral part, at least at this stage. It's more about getting over the hump.
Good. Well, that's actually in many ways nice to hear. So, just to, I don't know if you want to answer this question, but it's actually got to do with the EU ETS and the carbon markets. Is that something you yeah? I mean, basically, the question is that the EU ETS is a big system. It's again, it's one of these elephants in the room that has grown and grown, and nobody has really appreciated, oddly, how successful it is. Um,
Mm.
Now got a market of nearly $1 trillion every year
Yeah,
in the EU.
yeah,
And the UK has set up its own system a few years back, which is now,
yeah,
but this
yeah,
system is diverging. And this, I think, leads me to kind of 2 points here. You open in your opening remarks very early on. You said about the green hostility that exists, and we certainly are seeing that with this shift to the center right. Um, do you foresee conflict in particular with the UK over not running a system that is totally in compliance with the ETS?
right. Well, this issue was actually raised in May, I think it was May the 22nd, during the EU UK Financial Forum, which brought together the regulators in both the regions, and it was a prominent part of the agenda. There was, I think, more than an expectation, there was a pretty strong commitment on both sides to ensure that there was interoperability in terms of standards between the two regions, and that they would be working together, provide exchange of information to avoid complete divergence between the two systems. Not alone for ETS, but for other sustainability finance measures as well. So I'm not overly pessimistic at this stage, as long as there is a constructive, positive atmosphere adopted by the UK and the EU in the context of this EU UK financial forum, which seems to have started off very well. They've had two meetings, and they've both gone swimmingly well from the accounts I'm hearing. So I have no reason to believe that there will be significant, at least in this respect, the sustainability and ETS area, there will be significant divergences down the road. If you look maybe 5 years down the road, maybe not.
Thank you. We've only got time for really one area, and that means it's like 2 minutes, but I just lay it out if I might. It's got to go back to one of the most important bits for me in your presentation was anti-money laundering, and also very related to the future of these dialogues with Britain and the EU. Several points here. Kevin Parle again, that client due diligence has always been in scope under AML regulations. Therefore, all outsourcing agreements with third-party providers must be subject to contractor due diligence, etc. Um,
Yeah,
we have Nikki Holtz also is curious, about you can write regulations, but does the EU have sufficient resources to monitor the adherence to these extensive regulations?
yeah,
We in the UK have been terrible at this. My term as sheriff in 2019, 20, and 21 was all about, if Britain's open for business, try opening a bank account. How do we
yeah,
strengthen and simplify AML? Simplification being,
yeah,
one of your themes here.
yeah,
Um, but it's a morass out there. And we in the UK could live in that morass when we were in Europe, so to speak, because we were just a member nation doing our
mm,
thing.
mm, mm,
Uh, and everybody else was equally, but now we're an outsider and we
mm,
need to prove that we're coming in. But we are managing global assets here in London, which are
yeah,
being funneled by particularly Dublin and Luxembourg into the system. Um, and we are that third party provider. We are no different than Nigeria so far
yeah,
as the EU is concerned. This
absolutely.
sounds to me between what Europe wants to do with the oversee the site, the fact that our rules are a mess anyway and not in accordance with theirs. It sounds like a serious area ripe for financial warfare. What are your thoughts in 2 minutes?
Well, I'm not as pessimistic. I mean, I did say earlier that there were continuing divergences, the listing rules, MiFID, parts of the Basel III agreement, have been watered down. But in broad terms, in terms of, the orthodoxy approached by the EU and the UK, and again in the context of this EU UK financial forum, is to avoid regulatory arbitrage. That's the one thing that they're trying to avoid. And secondly, to ensure, if feasible, interoperability of standards. And when you get down to that level of detail where you're negotiating the standards to ensure that not alone, it's not a question that they're similar, but that the interpretation of the standards are similar, that the regulators are approaching it with the same frame of mind. But what's probably missing in all this is exchange of information. And what I think we are all hoping for is a more omnibus, as it were, exchange of information, memorandum of understanding that would ensure that the UK and the EU regulators are exchanging information on important issues in relation to derivatives clearing and trading, AML issues, DORA, and other related matters. So for me, I'm not overly pessimistic, but there are still a number of issues that need to be more comprehensively discussed to ensure, again, the end game for me is, are the regulators on both sides of the English Channel, are they interpreting the rules in the same way? Yeah, and if they're not, they need to come back to the table and negotiate and discuss ways of bridging those gaps before they become major issues. And the issue for the Commission in all of this is the fear, is the risk factor involved in financial institutions operating on behalf of EU financial institutions outside of the EU regulatory architecture. That is something that really does spook people in the regulatory environment, including the Commission in Brussels and elsewhere.
Great. Well, David, yet again, another extraordinary start to the year. I think it's wonderful for you to remind us about that. A couple of quick points for those out there. Firstly, thank you very much for your questions and comments. As I mentioned, David will get them all with emails, and I'll leave it to you. The recording will be available in about 2 days with the slides, and there'll be a link shared with all of you in a follow-up email. And please feel free to send the recording on to friends and family and anybody else who does it, who's interested, which I think is there. It's a great way to start. I would also like to point out, if I could, that we can't do this without thanks to our sponsors who are on the previous slide. But as we turn to forthcoming events, next week, Financial Centers of the World, Why Seoul Matters. And I think you're going to find this particularly interesting. This is an opportunity to go straight in to one of the big geopolitical areas going on and see what it actually means for financial services. We're going to have a reprise with our ever-friendly Raj Persaud, Dr. Persaud, talking about the psychology of worry. How can you stop worrying and love the future? And finally, at the very end of the month, those of you based in London, we're having one of our tours, but this time the walking tour is actually a pub crawl, but with a lot of history. So I'll leave it to you. But thank you so much, David, for your time and efforts. I know that I'm already getting messages in here with people thanking you, and I know many people provide applause as well. Unfortunately, the technology these days still hasn't quite worked out audio, so I have yet again brought along, in anticipation of next week, my Korean karmic clapper from a monastery in Korea. Thank you audibly. Wonderful, David. Have a great new year, everybody. Great start, and see you soon.
Okay, thank you.